Hey everybody, welcome to our January edition, January 23 of Monthly Market Matters, where we kind of recap what's happened here to start the year and then maybe what we're looking forward to here in the second month of the year. I'll kick it over to Kyle here at the beginning just to recap some of the numbers and what's happened here to, like I said, to begin 2023.
Yeah, Adam, just kind of recapping. I know that we did in December the year-end stuff, but I think it's pertinent just to kind of pull it up again here. I'll pull up a slide real quick on just the numbers to remind everybody. I know we try to forget and would like to move past 2022 here with the numbers, but it puts things in perspective here and highlights a little bit of what's going on this year so far in January. But just a reminder, it was the worst year ever for bonds, down over 13%. And kind of the second worst year was only 2.9. So it made it really difficult for us and clients that were going through the year, and seventh worst year for stock. So don't want to sit there and focus on that the entire day and the entire call here, but just did want to point that out before we kind of moved into January, where it seems to be a little bit brighter for us here. So
Kyle, too, I think even more so because there's been worse years for equities, of course, right? I mean, down 18 for equities is we don't like it, but it's fairly common. It's that most of our clients and most investors are somewhat balanced, right? They don't want to take full equity risk. And when you have a year where stocks are down like they were and bonds are down like they were, it really didn't matter whether you were balanced or you wanted full equity risk. You kind of just got it regardless.
And I think we talked about that a lot last year and in client meetings. It's the clients that are typically more aggressive are used to the volatility and maybe not panic or worry as much to it because, equities historically have moved more than fixed income. But last year was different in the sense that our balanced accounts moved pretty badly in the wrong direction too, and it was the worst year for bonds. So I agree. It definitely people aren't used to experiencing. So
balance didn't provide any balance.
No, did not. So kind of fast forward to January here. Surprising, we're off to a pretty good start for the year. I know that people are still kind of looking in the rearview mirror, but so far January has been positive. I'll give you an update on the markets here. The Dow is up a little over 2.5% for the month of January, and the S&P is up 5%. And then if we kind of look at the NASDAQ, which is our tech sector that definitely was drawing things down more than the value side last year, it's actually positive over 10% so far for the month of January. So not saying that's necessarily where we're going to finish and everything's going to go straight up from here on out, but we do like to celebrate when things are going in the right direction, and we've seen that so far in January. The ag, our bond index that we've referenced a lot, that was down, like we mentioned, about 13% last year, is actually giving us positive 3% so far this year. So both our aggressive accounts and our balanced accounts are kind of starting to move a little bit forward and claw back some of those losses from last year, which we like to see so far. Kind of things that we've been talking about here is what's driven the markets here in January. We always like to talk about what's going on numbers wise, but kind of the data or the talking points that you're hearing in the news or that we're seeing that's moving these markets, and really kind of highlight about 3 or 4 different areas. We had China, which had kind of been in essentially a zero COVID policy where everything was locked down, shut down, nothing was going to reopen until there was essentially zero COVID cases. And so kind of towards the beginning of December there, they had lifted that policy. And we saw a little bit of, opening back up in China, which is a positive thing for the global economy, which obviously is impacted here in America as well. So the other thing that we highlighted a couple times throughout the years, and we pointed out, was we thought that once inflation started to peak and started to slow down, we should start seeing, stocks in the market kind of start to recover. And we've seen that. So we had a peak inflation number back in June of around 9%. And our most recent reading that came out from December was around 6.5%. So again, that's something that we like to point out here, is that steady decline. We're not spiking the football yet and saying that, inflation's behind us and, the cost of goods are, back to normal and the lower levels that we're used to seeing. We still feel that at the grocery store and at the gas pump and things of that nature, but it's trending in the right direction for right now.
I think too, the fact that, this is a 12-month low. The previous low was back in January, and that was 7.5%. Mm-hmm. So we've actually dipped below, a full year ago at this time. It's never been under that level since January of 22.
Yeah, and like we were just talking in the office about it, that's great. We like to see this trend line. I like to see it come down. But if we sit here and pause and hang out at 5, 6, 7% for the next 12 months, nobody's going to enjoy that, and that's not something that we'd like to see. So, and so aside from those two things, the other thing that's been kind of a major talking point and impact on the market so far for last year and into this year is the Fed. Right. So the thing that we've been doing to combat inflation is rising interest rates. So if you recall, I'll pull up the slide here. Last year, the Fed raised rates 7 times. We started at essentially that, 0 to 0.25% for the Fed funds rate. And over the course of the year, it got all the way up to 4.25 to 4.5%. So that's why we saw the huge reaction from them in regards to trying to combat inflation. And that's really what led to a lot of the strong decline in our fixed income over the last year.
And I know, Kyle, we've shown a chart before that you can't see it in here because obviously this is just last year's rate increases, but comparatively, it's incredibly steep. It's the steepest rate increase in the last 4 or 5 rate hike cycles, and by a lot. I mean, you're looking at something that's almost straight up compared to other rate hike cycles that have been sort of a gradual 25 basis points at a time, and this was just monster moves. So still waiting to see the effects of that this year.
Yeah, and we remember that it was a sticker shock, right? When they had that first 75 basis point hike, everybody was like, "Whoa!" I couldn't imagine a 75 basis point hike, and then it was 4 in a row.
Yeah,
so
crazy.
It was definitely straight up. But that the reason also we talk about inflation and the rising interest rates and stuff that's been going on last year is it's also kind of what's driving these markets positive this year. Is we're starting to get some indication that the Fed, and we saw that in December with the lowering of the rate hike versus what we were expecting from previous months. That the steepness or the amount of hikes and the level of them are likely going to decline or come down this year. And so I know that we talked about what the Fed futures is kind of pricing in for the next Fed rate hikes. And so for February right now, it's a pretty high percentage, around 90%, that it'll only be a 25 basis point hike here in February. Which again coincides with the slowing down of the aggressiveness of the Fed, and showing that inflation, has come down quite a bit. We got a long ways to go, but that's one of the things that we were looking forward to. And all that stuff is pointed positive to kind of our consumer sentiment that we've talked about in previous calls, is that people are starting to feel a little bit better about things. I mean, I know it's not showing so at the grocery store. Cost of goods are still high, but we're starting to see people get out and about and spend a little bit more money and just more positive about the economy right now. So those are kind of the main things that we talked about here in the month of January that kind of allowed for the positive markets we've seen so far.
Yeah, and like we talk about all the time, it really wasn't that great in January. It's just, again, things are pre-priced into the markets, and when you have some sort of let off from the negativity that's expected, then you see that growth. We were just talking about like the tech sector with high interest rates and possibly heading into recession. That's not normally a sector that does really well. They do well in low interest rate environments, in a growth environment, and tech's up 10% in or the Nasdaq's up 10%, I should say, in January. What's that saying? I mean, it's basically just saying that maybe it was oversold before. Maybe it's not as bad as expected. So, going forward, got a couple of things we're looking at. I mean, obviously, there'll be many more things over the coming months. But in February, so we're still looking at a recession. We're still seeing slower consumer spending. Looking at a potential bear market in housing, and probably further declines in the manufacturing and services activity. I think the biggest thing, obviously, the elephant in the room we've already spoke about, is February 1st and what happens with the Fed, and not so much around the rate hike, because that's basically a 99.8% chance right now, I think, of a 25 basis point rate hike. So that's probably a certainty. But his language around, does he take a dovish tone as far as, hey, maybe we'll have to slow this earlier, and this is probably coming to an end, or we're willing to keep monetary policy tight as long as we need to combat inflation. It's really going to depend a lot on his
guidance and outlook.
Yeah, his guidance and outlook, and unfortunately, again, all the things I've read and heard, and kind of what we feel is we're going to have a pretty bumpy year. January, I think, again, people are, hoping, it's kind of the hope strategy, hoping that, we're going to ease up on rate hikes, and that things are going to have a soft landing. And then his vocabulary here in the next couple of days may put a little bit of a tailspin on that. So, again, all the signs right now show that we're probably going to be heading into some type of recession. But as we talked about before, it's not necessarily a bad thing. It's part of a market cycle. We don't love recessions, but you go through them. And then it's the degree. You talk about direction and magnitude. Direction would be recession, right? But magnitude is it negative 5% in GDP from a year ago, or is it negative 0.1? I mean, those are two very different things. So that's probably the biggest thing we're watching. I'll show you real quick the Fed funds chart, or the Fed watch chart. And just how you read this. So right now we're at 425 to 450 is where the market currently sits. You can see that first date is February 1st. So that's coming up in a couple of days. And it's almost 100% certainty that we're going to get a 25 basis point move. So then you go to the next one figuring, okay, we're probably at 450 to 475. And there's still about an 82% chance is what the markets are pricing in that we do another 25 basis points at that March 22nd meeting. But then after that, it's pretty much, it's pretty much flat. No signs of going to 5 to 525. And the thought is right now, maybe by the end of 23 before 24, we might actually see some rate cuts. And that's obviously going to depend on a lot of things that happen in the economy.
Yeah, it's really hard to look that much further down the line with the way that
Sure.
the Fed has moved here and how data dependent things are in the move environment, but at least it's not forecasting or showing for, continued drastic rate hikes. And the other thing I want to add to, Adam, is you're talking about the magnitude of recessions, right? And the direction being the recession, but then the magnitude is at 5% versus 0.1. The other important thing that we like to focus on, or pay attention to, is also duration, right? So is it one of those things that we're going to have a prolonged deep recession, or just kind of a shorter recession? I think that's a lot what will determine kind of what these markets do and what we're seeing on the ability for things to kind of come out of that and start to grow again. So,
yeah. And so, we talked about this a little bit last time, silver lining on rising rates. I mean, they're here, the rates are up. People don't always correlate that, hey, rising rates means, better interest rates for investors on cash, on short-term investments. So Schwab money market right now is 4.37%. It's an annualized number, assuming all dividends are reinvested. But I mean, it doesn't take very long. Maybe 18 months ago, we could go back and that number was very close to zero. Mm-hmm. So it shows what drastic interest rate increases can do. And then you got treasuries, so money market's a daily liquid thing that obviously the rate changes every day, depending on, how the market's moving and how rates are moving. Treasuries, here's some of the rates on treasuries. 3 months, 4.67, again, an annualized number. 6 months, 4.83. 9 month is 4.75, and then 12 months is 4.75. So you can see for short-term investment, cash, what we would call cash management or cash alternatives, you can earn a decent rate of return where, this wasn't happening 18 months ago. And then you got CDs, which everyone understands. CDs, just a different, the bank side is 4.75 for a year. So that's kind of where, again, where short-term rates are. And we are seeing a lot of people take advantage of that, because if you compare that to, your checking account or savings account rate, it's probably pretty drastically different.
And it's been a while since we've experienced those levels, those rates, and being able to actually be rewarded for cash or do something with cash. And so, like you said, CDs too, even the 9 months are down about 4.6 right now. So you don't have to lock money up for a long period of time to get a decent bit of interest on it right now. So that's one of the positives to the rising interest rates we've seen.
For sure. And then, so one of the things we like to talk about is just things that are going on in the market, the economy, the nation politically. And one of the things that is being thrown around a lot right now is the U.S. government debt ceiling. So just thought we'd talk a little bit about the debt ceiling, what it is and how it's affected. So the debt ceiling is the max amount the government is allowed to borrow to pay for already approved spending. And it sounds like, when you hear the word ceiling, typical politics, right? Whenever you hear something, you think it's, ironclad, like ceiling. Oh my God, we can't go above that. We've already hit the debt ceiling limit, and implemented what they call extraordinary measures to pay bills. And extraordinary measures just means that they're going to suspend some reinvestments in government savings and benefits plans and basically redirect funds elsewhere and make sure that they make their bond payments, their treasury payments. So how does this, you can see on the slide, how does this compare to previous times? Well, they've done this 100 times since World War II, raised the debt ceiling limit. It's been, raised 22 times over the last 25 years. And the real thing is the hard deadline is expected to hit in June. This is sort of a softer deadline. And it becomes, I think it was originally set up, and I've read that, it was supposed to be fiscal responsibility. You've already approved this spending. You have an amount of debt that you're willing to take on, but no more than that. And it's supposed to be for fiscal responsibility by the government. As you can see, when you raise something 100 times, you probably are not very fiscally responsible at this point, and you can see the magnitude of the growth in debt. it's really more of a political bargaining chip. So whoever's not in charge or whoever wants a favor will hold the other side hostage, and and it'll be this back and forth coming down to the wire. So what to look for with this? Right now, I would say this is more of a nothing. There'll be a lot of verbiage about it back and forth, but there's not really a lot happening now. The hard deadline will be a more serious date to target, and that'll likely be in June. And like in 2011, we went through a credit downgrade. So if they start messing around enough where they don't pass a higher debt limit in order to pay bond debt, and we default on some bond debt, then that's a much bigger issue. Hasn't happened in the past. Don't expect it to happen this time. But that's kind of the whole verbiage in the talking around the U.S. government debt ceiling and how that affects.
Yeah, and like you said, it's the changing and the raising the debt ceiling doesn't really mean a lot from a market standpoint. It usually comes down to the 11th hour and they figure out something to usually means more spending. But like you said, the thing we're watching for and paying attention to is potential of not hitting or not extending it, and then the potential of a credit downgrade, which I think was 2011.
I think 11 was the last one. Yeah, where they did the credit downgrade, which ironically, so all money poured into treasuries after the debt downgrade, which if you understand the debt downgrade works, you're basically saying that the U.S. government debt isn't worth as much. And then a bunch of money piled into treasuries because still the safest asset class in the world, regardless of what the. But I think the credit thing signifies that hey, maybe we got some issues. Maybe we have a few things that are going on that we got to fix. And I think we all kind of know that with politics in general.
Okay. What else do we have coming up here for Strong Valley? I know that this is our monthly Market Matters. Those of you that hopefully are finding value from this. As you remember, we rotate kind of, there's always two of us on this. Sometimes it's me and Adam, or me and Jason, or Jason and Chris, or whatever that dynamic looks like. But those do come out monthly. So hopefully you guys are finding value from these. I encourage you guys to like and subscribe to them so that you can get them going forward as well. They are up on our website too, if you want to go back and see any of the previous monthly Market Matters. And that's at strongvalley.com. And then also, I know we have our quarterly roundtables that we've been doing that are coming up here too.
Yeah, quarterly roundtable coming up in February. Definitely like and subscribe. Share these around if you can. Said hopefully they're timely and short enough that you can get some good information from it. Said we do this every day. We're sitting around, we listen to these things, so it's good to be able to share with everyone in a compact format. But the roundtable is coming up in February. We do try to do one of those every quarter during the middle of the quarter, mid-quarter roundtable, and talk a little bit more in depth. We talk about questions we're getting from clients because if one person's asking a question that 10 other people probably have that same question. So try to answer some things, except just a deeper dive into the markets and everything we're hearing. So appreciate everybody tuning in today. Said if you got suggestions for topics, we're always open to hear those things. We want to talk about things that people are interested in. Yep. And otherwise we'll see you on the quarterly roundtable.
Thank you all. Take care.